So what do we mean by technical analysis? It is the study of collective market sentiment with the objective of understanding the future direction of stock prices. So we try to determine whether the market is bullish, that is in a positive mood, or bearish, and what does that mean for stock prices in the near future. So technical analysis usually will not try to determine long-term behavior of stocks or long-term movements. However, it would try to predict the short-term movements by analyzing the market sentiment at the moment. Few assumptions that go into the study or the use of technical analysis are: one, that market price is determined by demand and supply. Now this is a fairly acceptable assumption. Market price is determined by how many buyers are there and how many sellers are there. If there are more buyers than sellers, then the stock price can be expected to go up. If there are more sellers than buyers, then the stock price can be expected to move down. It assumes that market prices reflect both rational as well as irrational behavior. So rational, we mean as defined by the intrinsic values, the fundamental values of the stock, and irrational because of, let's say, people's emotions or people's fear or greed. So sometimes we are selling into stocks not because it's fundamentally justified, but just because we don't want to be in the market anymore, or we are tired of investing. So prices reflect, or supply and demand comes from both rational as well as irrational behavior. Also a fairly acceptable assumption in my opinion. He assumed that efficient markets hypothesis does not hold. So what were the four conditions? Please refer back to the video on equity analysis to understand what are the four conditions for efficient market. Information comes in a random manner. Large number of profit maximizing participants exist. Investors adjust their expectations instantly. So all these assumptions do not hold in the real world is what technical analysis assumes. So efficient markets proved that technical analysis is useless, or we cannot predict price movements by analyzing previous or historic price and volume data. So efficient market hypothesis should not hold. It assumes that trends and patterns tend to repeat and can be used for forecasting. So with the following assumptions, we'll see in future slides how patterns can be identified or can be used for predicting future stock behavior. So let's see how technical analysis contrasts with fundamental analysis. Fundamental analysis tries to determine the fair value of an asset. So we discount the cash flows, we apply relative techniques, and we try to come to the fair value. Technical analysis has no such ambition. So technical analysis only tries to predict the stock price. And how does it do that? Not by analyzing cash flows or fundamentals, or by understanding the company, understanding the business model, so on and so forth. It just wants to use historical price patterns and historical trading volume data to project future stock prices. Technical analysis is not concerned with identifying buyers and sellers' reason for trading. Rather, it only wants to use the actual trades that have occurred to predict future possible trades. So it's not considered, it is not concerned with the reason for trading, it is only worried about the actual trading. So what are the few of the advantages and limitations of technical analysis? Price and volume data are observable. This does not mean that technical analysis is not subjective. So technical analysis also involves subjectivity, just like fundamental analysis. However, The good part is the price and volume which are used in the analysis are at least observable, whereas much of the assumptions that are or the data that is used in fundamental analysis is subject to assumptions and is subject to a lot of input variability. It can be applied to assets that do not produce cash flows. It is useful especially when financial statement fraud occurs. So if financial statements are misrepresenting the actual business performance, then fundamental analysis cannot be used, because fundamental analysis starts off with the financial statements and then we do the analysis and derive the stock price. So if financial statements are incorrect, that is there is fraud, then fundamental analysis cannot be used. However, price and volume data may reflect the true value even when fraud or even before fraud is widely known. So the objective here or the assumption here is that some people would know about the fraud before the entire market does, so the stock price may correct as the price and volume data may reflect the true price even before the broader market has found out about it, or fundamental analysts adjust their expectations. So fundamental analysts would adjust their expectations after the fraud is known and after it's public information. So the section on technical analysis has significantly been enhanced from the previous few years. So for those of you who are taking the exam again, please make sure that you understand the new sections very well. What are the limitations of technical analysis? Its usefulness will be limited if price and volume do not truly reflect supply and demand. So if it is mainly irrational behavior, or it is a reason such as illiquidity or outside manipulation that are causing stock prices the way they are, then future stock prices may not be very well predicted by technical analysis. Secondly, he says that for bankrupt companies, short covering can create positive technical patterns even when it is known that the stock price will go to zero. So let me explain what this means. If a company is bankrupt, what would you likely do with the stock? Or if you're sure that the company is going to go bankrupt, what will you do with the stock price? You would sell it, you would short it. Now if you short it, you borrow the stock from someone and sell it in the market. At some point you would have to cover the short, that is, you'll have to buy it back and return it to the board or return it to the lender. Please review the section on equity analysis if you have forgotten what shorting a stock means. Okay, so view that video again and you'll understand what shorting means. So when you're short covering or you're buying back, and if a lot of people are buying back, then there can be a positive blip, or the stock may rise for some reason, and technical analysis, as we will study in the future slides, may predict that this is a positive pattern or the stock is going to go up from here on, which will be incorrect. So in special cases and in certain market conditions, technical analysis may not be very useful. Now, when we will do technical analysis, we will deal a lot with charts or distributions. So these charts will normally have price or volume information on the y-axis, my apologies. So y-axis will normally have price data or volume data, whereas the x-axis would be a time series. So the x-axis would be time in most of the charts, and y-axis would be the price. So on August 1st, let's say the price was 35. On September 1, the price was 55. So on and so forth. So let's look at different types of charts now, and let's see how we can make use of these charts and try to predict future prices. Now, one way of representing the price information is using the line chart, as we saw in this slide. So price on the y-axis and time on the x-axis. Another way of representing the same information is using bar charts. So let's see what happens in a bar chart. So a bar chart would contain the day's highest price, the day's lowest price, and the closing price. So the day's lowest, highest, and closing price are indicated on each date. So on 15th August, let's say $5 was the lowest price, 5.5 was the highest price, and the stock pretty much closed near the day's low. So on 17th of August, $5 was the lowest price, 5.6 was the highest price, and the stock closed. You see the slight cantilever coming out represents the day's closing price. So a bar chart would represent the day's low, day's high, and the closing price. Another way of representing the same information, the line chart simply represented the closing prices at the end of each day. In a bar chart, we can give a little more information. Instead of having bars, we could represent the information in the form of candlesticks. So candlesticks also represent the movement between the day's high and the day's low. Down movements are represented by black, and up movements are represented by a white candle. So we basically just learned different ways of representing the price information, or different ways of showing how price has moved on a particular day. So on a particular day, the stock ended at this price, or the stock ended at, the black portion represents a stock price fall, whereas white candle represents a stock price increase. So if the candle is white, that means the stock price increased on the day. If the candle is black, that means the stock price decreased in the given day. So you can have your own definitions, you can have different colors, whatever. So this is the way that a candlestick or price information can be represented in the form of a candlestick, not in the candlestick chart. Another way of representing the price information is using a point and figure chart. So each tick or each movement in price is represented by one box. So in the given figure, one box means one unit movement in price. So if the stock went from 80 to 80.5, there will be no representation. If the stock goes from 80 to 81, that will be a movement of one box. If it goes from 80 to 82, it will be a movement of four boxes. So in this case, 0.5 is the width of one box. So a movement of 0.5 units represents 1 tick. Now the cross represents an up movement and the O represents, or the 0 represents, a down movement. So the x-axis will again be time and the y-axis is the price. So on the first day the stock closed at 80 and rather it began at 80 and it closed at 82. So there were a movement of 4 units. So I'll put 4 crosses up. On the second day, on day 2, the stock fell from 82 to 77. So from 82 I will put 1, 2, 3, 4, 5, 6 crosses and bring the price down to 79. My apologies, it will be 79. So the date is on the x-axis and the movement is on the y-axis. Again, starting from 79, the stock went up to 82.5. Because it goes up, I will put crosses. So it goes up to 82.5. Down movement is represented by O's and up movement is represented by crosses. So there is no specific use of these charts per se in this topic review. You just need to understand that there are different ways of representing the price information. So the stock ends up from 76 to 79, then I would represent the up movement using zeros. So this is called a point and figure chart. The y-axis is the price information and the x-axis is the time. Similar to a price chart, we can have volume charts as well. So volume data is the amount of trade or the number of shares that get traded in a particular stock or in a basket of stocks in a particular day. So the y-axis will be the volume or the number of shares traded, bought or sold, and the x-axis would be the time. So this is how we represent a volume chart. The y-axis represents the number of shares traded. Some days it's high, some days it's low. And the x-axis represents the time. In future slides we'll understand how this information is used. So we've learned different ways of representing the price and volume information. Now let's try to understand how we use this information. So a lot of technical analysis has got to do with understanding terms called trend, support, resistance, polarity, so on and so forth. So an uptrend represents a situation when the price is continuously moving up or is higher than the previous price. An uptrend is constructed by connecting increasing lows. Okay, a breakdown may suggest reversal. So let's understand what this means. So if you see from point between point A to point B, I can see an uptrend. The uptrend would be plotted by connecting consecutive lows. So I'll connect this low to this low to this low, and I will plot an uptrend. So that's how we plot an uptrend. What you see thereafter is called a breakdown. So a breakdown happens when price significantly deviates from the trend. So when price significantly deviates from the trend, so this is a breakdown. Breakdown normally represents resistance. So what we mean by resistance is that at this price the stock is met by a lot of selling pressure, or it is difficult for the stock to go above this point. So this is the point where a breakout happened. Now this level will become the resistance level for the stock. So this line that we've just plotted will be the resistance line. Thereafter, when the stock price moves up, it can be expected to face resistance at this price. 70 was the price where the breakdown happened. This is the price where the breakdown happened. So this was the uptrend. The uptrend was broken down here when the prices significantly deviated from the trend. So the point at which the breakdown happened would now become the resistance point. That is, whenever the stock price moves up to this price, it can be expected to be met with some selling pressure. Okay. Similarly, let's try to understand what a downtrend is. So a downtrend happens when the prices are continuously moving down. So a downtrend is plotted by connecting consecutive highs. So if I connect consecutive highs, let's say from this point to this point, then I could have said to have plotted the downtrend. So this is where we've plotted the downtrend by connecting consecutive highs. So the high here, the high here, and the high here. So we are plotting a downtrend. This movement which significantly deviates from the trend on the upside would be called a breakout. So this was called a breakdown. This movement was called a breakdown. This movement would be called a breakout. Now, see, trends, polarities, resistance, you can look at it at different points. You can look at it on a daily basis, on an intraday basis, on a monthly basis. So depending on what is your time horizon will decide what the trend is. So you may argue that there is a uptrend in between the downtrend. So here if I see there is an uptrend. All that will depend on what kind of time horizon you are looking at and what kind of trading horizon that you have. That will define. So I am looking at more a 15-day or a monthly horizon. So my trend over the period from September mid to October mid is a downtrend. Of course, amongst this downtrend, there may be a few uptrends, there may be many other trends, there may be many other patterns. So, now we are in a downtrend. This movement on the upside is called a breakout. So, a breakout defines a support level. Or when the stock price now comes back down at this level, when the stock price comes back down at this level, then we can expect that there will be some support or there will be buying emerging into the stock. So support are levels where buying is expected to emerge. Resistance is a level where selling is expected to emerge in the stock. So a breakout indicates a support level. So the downtrend was broke out here. So this point at which the breakout happened can be expected to act as support. Okay, so we understood what resistance means. Resistance is where a breakdown happens. So let's see, this was an uptrend, a breakdown happened. Support is where a breakout happens. At the moment we're just trying to understand uptrends, downtrends, breakdowns and breakouts. Support becoming resistance, resistance becoming support, we'll understand next. So just understand, support is a level at which buying is expected to emerge, or the stock price is not expected to go below this level. Resistance is where selling is expected to emerge, or the stock price is not expected to easily go above this level. Breakout is where a downtrend gets broken. Breakdown is where an uptrend gets broken. So this leg would be called a breakout. This leg would be called a breakdown. Breakdown is where an uptrend gets broken. Breakout is where a downtrend gets broken. Breakdown represents resistance. Breakout levels, so breakout points represent support. So just like breakouts and breakdowns represent support and resistance, a few other points also sometimes act as support and resistance. These are round number prices. So if a stock price is falling and it falls down to a value of 100 or 50 or 200, then just for psychological reasons it has been seen that these round number prices can also act as support or resistance. Historic highs and historic lows also act as support and resistance. So a historic high can act as a resistance, a historic low can act as support. It has been seen. So support is a point where buying is expected to emerge. Resistance is where selling is expected to emerge in the stock. Now, change in polarity represents the fact that a breached resistance point often becomes the support for the future, and a breached support often becomes the resistance for future. So in this case the uptrend got broken here. This uptrend was broken here because there was a breakdown. Because there was a breakdown, the level of 55 became resistance. However, this level of 55 was breached in this uptrend. When this uptrend happened, the level of 55 got breached. A breached resistance becomes support. Now the level of 55 will become the support. Earlier it was the resistance level, now it will become the support level. So when the stock price comes down again, it can be expected to have buying at the earlier resistance or at the level of 55. So breached resistance becomes support, and breached support becomes resistance. So when the stock price fell from here to here, then the support level was breached. Now when the support level is breached, it will now become the resistance. So next time when the stock moves up, it can be expected to be met with selling pressure. It will become a resistance now. So understand, change in polarity refers to the phenomena that breached resistance becomes support, future support, and breached support becomes future resistance. Resistance is where selling is expected to emerge. Support is where buying is expected to emerge. So certain patterns are called reversal patterns. Now reversal patterns are patterns where a trend is expected to reverse. So a trend has reached a point and the trend is not expected to continue, rather it is expected to reverse. So an uptrend is expected to become a downtrend, and a downtrend is expected to become an uptrend. So a few very popular reversal patterns. The first one that we'll study is called the head and shoulders pattern. So head and shoulder patterns looks like this. So there are two shoulders and there is a head. So the stock price has been in what trend up till now, or if I see the history from the beginning, the stock is seen to be in an uptrend. However, the stock does not keep going up. This would have been a continuous uptrend. The stock falls, then again goes up, then again falls, then again goes up, then again falls. So this kind of a pattern is called head and shoulders formation. Can you see a head and can you see two shoulders? This will be the head and these will be the two shoulders. The line that is connecting the base of the head or the base of the two shoulders is called the neckline. So this line is called the neckline. The size of a head and shoulders formation, that is, the size of a head and shoulders formation is called the difference between the peak of the head and the neckline. So this difference is called the size of a head and shoulders formation. Head and shoulders formation. This is the neckline. This is the head. So this line is called the size of the head and shoulders foundation. This size can be used to predict the extent of the downfall. If the stock follows a head and shoulders pattern, then the stock can be expected to fall. This is a reversal pattern. It has been seen that after stock forms such a pattern, it normally falls. How much does it fall by? By the extent of this size. That is the difference between the peak of the head and the neckline. So a similar fall can be expected in the stock in the future. So a head and shoulders represents that an uptrend is expected to turn into a downtrend. Similarly, an inverse head and shoulders will happen when a downtrend is expected to become an uptrend. So if a downtrend is expected to become an uptrend, then a possible formation that you may see is an inverse head and shoulders. Another reversal pattern is called the triple bottom. Triple bottom or the double top means the same thing. So do we see that the downtrend is not able to continue? So downtrend is not able to continue. The downtrend, this would have been a continuous downtrend. So downtrend breaks such that it goes up, then it comes down again and it forms a double top. If it forms a double top or a triple bottom, then the expectation is that the downtrend can possibly become an uptrend, or the downtrend will reverse into an uptrend. This is called the double top or the triple bottom formation. Double top or the triple bottom formation. It represents the expectation that a downtrend is expected to become an uptrend. Similarly, there can be a double bottom triple top. Again, a double bottom triple top would represent that an uptrend is expected to become a downtrend. Now, all that we are studying, guys, does not have any fundamental basis, or is not is just a study of historical behaviors of stocks and historical patterns, and is a conclusion that historically it has been seen that when stocks form such patterns, in the future stock's price behaves in this way. By no means does it mean that the stock price actually will fall, or the reversal will happen. So when we started the review on technical analysis, the first slide that we discussed was the assumptions that go into technical analysis. So all these conclusions are only after those assumptions, which may or may not hold in the real world. So these patterns are historically seen to repeat, but there is no guarantee that every time or in this specific case it will repeat. However, the expectation can be that if the stock forms a head and shoulders, that an uptrend can turn into a downtrend. Or if the stock falls a triple bottom or a double top, then a downtrend may become an uptrend. So these are reversal patterns. The size of the head and shoulders is given by the top minus the neckline. So this size is the expected extent of the down move. So when the down moves happens, the stock can be expected to go down by the size of the head and shoulders. You need to remember all these patterns and theories. Inverse head and shoulders, a downtrend will become an uptrend. Triple bottom or double top, a downtrend will become an uptrend. Double bottom or triple top, again an uptrend may become a downtrend. So another type of patterns are called continuation patterns. So in a continuation pattern, what we conclude is that the trend is not reversing. So in reversal patterns that we studied in the previous slide, the trend was expected to reverse. In a continuation pattern, what we see is that the trend is not reversing, but it is seen to have taken a pause, or the trend is having difficulties carrying on. So the first type of continuation pattern is called a triangle pattern. So in a triangle, the stock price is following an uptrend or is moving up. However, as we see, after a point it finds difficulty sustaining that up move. So it continues to move up, but beyond a point it flattens out. It cannot continue upwards. So it goes up a little more, then it comes down. So if we join the peaks and the troughs, we get to a triangular pattern like this. So if we see a triangle pattern, then the expectation still is that the uptrend will continue. However, it has taken a bit of a pause. So the size of the triangle please understand this well. The size of the triangle is the difference between the peak and trough at the time of formation. So at the time of formation of the triangle, this is the difference between the peak and the trough. This would be called the size of the triangle. Now where is the size used? Size is used to predict the extent of the future up movement. So in the future, the stock can be expected to go up by the size. So in this case, let's see, when the triangle was formed, how do we know it's a triangle? So stock was going up, it went up, however it wasn't able to sustain the up, it came down to its original levels. So we saw that a triangle pattern was formed. At the time of formation, if this up move had been really high, let's assume the stock is in an uptrend, then it goes really high and then it comes back again, then the triangle pattern would have been even bigger. If this up move was even higher initially and then it came down, then the triangle would have been even steeper. So this distance is called the size of the triangle. That is at initiation. At initiation, what is the distance or what is the size of the triangle? So in this case it comes out to be, let's say, between 235 and 245. This level is approximately 245 and the down level is approximately 235. So 10 units is the size of the triangle. This is the bottom and this is the top. So after this point where the triangle formation is complete, the stock can be expected to move up by 10 units in the short term. So future, if it forms a triangle, that means the trend is expected to continue. It just indicates a pause and the trend is expected to continue. The size of the up move can be predicted as the size of the triangle. Similarly, even if the stock formed a rectangle, even if the pattern formed a rectangle, it means the same. So to take an example, let's assume the stock price was moving up and the stock price moved from 220 to levels of 235. Does everyone understand? It moved up to 235. Thereafter the stock price immediately jumped up to 245. From 235, within next 2 days the stock jumped up to 245. Thereafter the stock came back down to 236 levels. So I will say that the formation is a triangle, or the shape that is observed in the stock price movement is a triangle. I can calculate the size of this triangle as the difference between the bottom and the top at initiation. At initiation, the difference between the bottom and the top is 10 units. So the triangle is complete. The size of the triangle is 10. So technical analysts will conclude that the stock is expected to continue with the trend, and in the short term we can expect a movement of about 10 units. Now guys, I can give you theories why this is or why it is not. You don't have to know this. This is not a fundamental reason, it is not a fundamental calculation. There is no why this happens. It has just historically seemed to have happened, hence we are learning it. You may not agree with it, you don't have to. I personally don't agree with these theories, but I have to learn what has been researched and what has been seen in history. So a triangle pattern, I can argue why this happens, but I will not get into that argument. We don't need to know that. So does everyone understand what the triangle pattern is? So it's a fact that you have to, it's not a concept, it's a fact that you need to know that if the stock forms a triangle pattern, then the trend is expected to continue and the size of the uptrend is given by the size of the triangle at initiation. Good. Similarly, the stock could have formed a rectangular pattern as well. The size of the rectangle also represents the same. Even a rectangle is a continuation pattern. So the stock goes up, then it goes down, then it comes down, then it goes up again. It forms a rectangle. Again, the trend is expected to continue. So even for a rectangle, the trend is expected to continue, and this extent of the up movement is basically the size of the rectangle. So the time frame in this case would be in next few days, next week. So this pattern was formed over a week, so over the next week. So the time frame depends on the time frame that you are looking at the pattern. So if you are looking at a yearly, so the time frame in technical analysis can be few minutes to centuries. People analyze patterns over decades. So the time frame depends on the analyst. It depends on the technical analyst as to what frame of reference or what time frame is he using. So there is no standard answer to that. You may do the technical analysis on a daily basis. Somebody may do it on a 20-year basis. Triangle formations are also called pennants. Rectangle formations are also called as flags. So a pennant is the same as a triangle, or a flag is the same as a rectangle. The next category of pattern that we use to predict price behavior is called moving average lines. Very important, guys. So a moving average is simply the arithmetic mean of last n closing prices. So a 10-day moving average would be the average of the stock price over the last 10 days. 1 day later, the moving average would be calculated by using the closing price for that day and the 10 days before that. So the last one value will keep getting dropped. As I move on to subsequent days, the last day would start getting dropped from the computation of the average. So let's just take the example of some data and compute the 3-day moving average. So let's compute the 3-day moving average for this data. So I can start only with the 3rd day. So 3rd day moving average would be 5 plus 4 plus 1 by 3. It will be 10 by 3. After that, 1 would get dropped. For computing the next day's moving average, I will drop 1. It will just be 5, 5 and 4. So it will be 14 by 3. I am computing a 3-day moving average. This will become 12 by 3. It will become 10 by 3. So on and so forth. So the moving average at any point can be computed as that point plus the previous 2 points divided by 3. That is a 3-day moving average. Similarly, I can compute a 5-day moving average. Now, moving averages are used to smoothen the fluctuations. You understand that prices may be very volatile, but moving averages will not be as volatile because moving average only contains 1/nth of the last price. A lot of the moving average calculation is the same as the previous calculation because only one value changes. In a subsequent moving average calculation, vis-a-vis the previous calculation, there is only one value which is different. That is, the last value gets dropped and a new value gets added in its place. There are still n values or 3 values in the case of a 3-day moving average. Hence, it will be a lot more smoother than the daily price volatility. So, in an uptrend, the incremental price or the new price is higher than the previous moving average. In a downturn, the incremental price or the new price is lower than the previous moving average. So the moving average was, let's say, 4 plus 1, 5 plus 5, 10 by 3, it was roughly 3.33. So next price is 5. Then I will conclude that this series looks to be in an uptrend. However, the next price came 2, so I can't really say that trend exists. So in an uptrend, the incremental prices are higher than the historical moving averages. Similarly, in a downturn, the incremental price is lower than the preceding moving average. Or is lower than the moving average. So let's just take an example. So this would be the example of an uptrend. You see, the incremental price is higher than the moving average. So this line in the middle, the straight line or the smooth line in the middle represents the moving average. This is an uptrend because the incremental prices are higher than the moving average. This represents a downtrend because the incremental prices are lower than the moving average. So, moving average lines themselves, please understand, are often viewed as support or resistance levels. So let's look at the graph and understand. So let's look at the point, or let's look at this uptrend from this point to this point. This is the moving average line. Because the incremental prices are higher, the moving average is lower. The moving average line is often represented as a support level. Now if the price moves down such that the price intersects the moving average, then this point is expected to be a support level. That is, the stock should find it difficult to move below the moving average. Similarly, in case of a downtrend, so we see this is as a downtrend. Connect the tops. The moving average line is above the incremental prices. Again, the moving average would now act as a resistance. That is, the stock would find it difficult to go above this point. It would find it difficult to go above the moving average. So moving average line often represents a support or a resistance. Where the short-term moving average crosses above the long-term average, it indicates an uptrend, or you should buy into the trend. Where the short-term moving average crosses below the long-term moving average, it indicates a downtrend, or it indicates bearish sentiment, so you should sell into the trend. Now let's understand. Let's assume that I plot two moving averages. The moving average that I've plotted here is, let's say, the 100-day moving average. So I represent A as the 100-day moving average, and I represent B as the 10-day moving average. When I compute the values for A, I take the moving averages for the past 100 days, and when I compute the average for B, I take the moving average for the past 10 days, or I take the past 10 values. So this is A. Now let's assume the short-term moving average. In this case it's an uptrend, so the short-term would be higher because the preceding values would be higher. So the short-term moving average would be something like this. Again, as the short-term falls, the short-term will fall faster than the long-term. So wherever this intersection happens, wherever the blue line is the B, or the short-term moving average, and the black line or the original line is A, is the long-term moving average. So if the short-term moving average intersects the long-term moving average from above, or it crosses below, so this is a crossing below, then the stock is expected to be in a downtrend. Whereas when the short-term moving average intersects the long-term moving average from below, that is, if the blue line cuts the black line from below, that is, it crosses above the long-term moving average, then the stock can be expected to be in an uptrend, or the sentiment is bullish, or we should buy into it. So when the short-term moving average intersects the long-term moving average from above or crosses below, then the sentiment is expected to be bearish, or the stock is expected to move down. It indicates selling the stock. And when the short-term moving average intersects the long-term moving average from below, or it crosses above the long-term moving average, then the stock can be expected to be in an uptrend, or the sentiment can be expected to be positive. So next we understand the concept of Bollinger Bands. So Bollinger Band is basically one standard deviation above the moving average line. So whatever is the moving average, you add one standard deviation to it and you will get to the upper Bollinger Band. You subtract one standard deviation from it, you will get to the lower Bollinger Band. So at every point, first compute the moving average, then add one standard deviation. So if you are computing a 10-day moving average, add one 10-day standard deviation and subtract one 10-day standard deviation. So you will come to the lower Bollinger Band and the upper Bollinger Band. The assistance that Bollinger Bands provide us is that they help us identify if the stock movement is really extreme. So in the given chart, we don't see any actual price movement that is in excess of the Bollinger Bands. However, let's say if in one particular day the stock moved like this, it moved like the blue line, then a technical analyst could conclude that the stock is overbought. That is, there is excess buying in the stock because it is way above the Bollinger Band. So this is the moving average, that is the historical average of the stock, and even one standard deviation away from the stock is this range. If the stock really goes so high, then we can say that this is some abnormal buying. You should sell into this buying. You should be a seller here. Similarly, if the stock corrects steeply let's say the stock just falls to a very low point and comes back, then we can say that this selling is irrational, or a technical analyst would conclude that it is too extreme. The stock is expected to go back up, so you should be a buyer into this weakness. The stock here would be oversold. So Bollinger Bands help us identify points where the stock is overbought or oversold.